Healthcare, the Travelers, America's Umbrella. By MFS. MFS helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. We believe the most important thing we earn is your trust. Prudential Securities. Produced Friday, October 8. Our panelists are Eddie Brown, Frank Cappiello, and William Waters. Tonight's special guest is Thomas Monahan, Director of Research, the First Boston Corporation.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was a week of embarrassing revelations. The tone was set by that eminent American philosopher, Joey Buttafuoco, who finally confessed to something less than universal astonishment that yes, he had fooled around with Amy Fisher after all. Gosh, who would have suspected it? Then the mood of confession spread to big-time corporate America, as it was revealed that neither the present chairman of the Ford Motor Company nor the man who is about to replace him actually owns an automobile. Ford apparently has a better idea. Don't do as I do, do as I say. And at week's end, embarrassment spread to some of the high muckamucks of Wall Street, who have persisted in predicting all year, ever more incorrectly, but golly, who's counting, that the historic bond rally had now gone about as far as it could go, and that horrible old inflation was about to send interest rates seriously skyward. Then came a new array of reports confirming that job growth remains distressingly weak, at least outside the ballooning ranks of government, and that you need the Mount Palomar telescope to locate much evidence of inflation these days. The bond market, which had been made skittish by all the scare talk earlier in the week, promptly soared to levels that brought long-term interest rates near generational lows. And even before the latest evidence that the economy's advance remains glacially slow, mortgage rates were tumbling again, taking the average rate on adjustable mortgages down to just over 4.25%, the lowest since tracking of such mortgages began nearly a decade ago. The bond rally over? Well, not this week, sister. All these embarrassing revelations left the stock market thoroughly baffled. Not, I grant you, the most difficult thing to do. After a roller coaster week of charging upward as inflation fears faded and sweeping downward as concerns mounted about corporate profits in this anemic economy, the market split the difference and ended virtually unchanged, making it the smallest movement in the weekly averages in more than a year. Indeed, if you weren't an institutional program trader playing games with your computer, you probably would have found more action during the seventh-inning stretches at the baseball playoffs. And that could be the most embarrassing revelation of all. We tonight will talk with a fellow whose face doesn't have to be read, a top-notch strategist, tonight making his television debut, who has calmly called the turn on 1993, while the wrong way Corrigans and fearful Fosdicks were panicking as usual. But first, let's go visit the place with no shame and see what actually did happen this past week in Wall Street. And as the Dow Jones Industrial Average indicates, traders shrugged off troubling international concerns from Moscow to Mogadishu and ended about where they started, with the Dow eking out its third weekly advance in a row, up less than 4 points to 3584.74. And the broader indexes were just plain mixed, though the Amex finished the week with its fourth straight record. A record of another sort is being set by our elves, the 10 leading market technicians who vote each week on the Dow's next 6 months, haven't changed a vote now in 20 weeks, which means their index is still bullish. The global turmoil briefly stirred interest in gold again, but the metal couldn't end the week above $360 an ounce, and those falling interest rates nudged the dollar lower against every major currency but the yen. Meanwhile, for those still trying to sort out precisely what a so-called new Democrat is, or for that matter, what precisely makes an old Republican, fresh data came this week from Labor Secretary Robert Reich, who hailed cheering union conventioneers as brothers and sisters, and informed them without any qualification or ambiguity that the Clinton administration's agenda was, in his words, exactly the same as the AFL-CIO's. So at least we've got that settled. Frank Cappiello, are you getting sorry that you sold all your long-term bonds?
No. We still think we're right. That we think bonds have topped out at the low at 584 on the 30-year bond. Fortunately, we have a lot of utilities, so we're sort of hedged there. But I think the trend's still up in the stock market. Maybe the bond market will, be sort of friendly.
Well, what do you think the next surprise is going to be? A stronger than expected economy?
I think the earnings could be the surprise, Lou. A stronger than expected earnings. I think part of that will come from Europe next year in 1994. We're starting to see the pull of exports now. And if you look at Europe, you see a strange thing of two markets are making new highs there, the British market and the German market, anticipating a good 1994.
They're anticipating that they will join us in the recovery in which, however slow, we're ahead of them.
Exactly. We're about a year and a half ahead. The Canadian, sorry.
Go ahead.
I was just saying the Canadian economy has already started to cycle upward, and I guess sometime late next year, Japan will have sorted out its problems.
Bill Waters, this week the market seemed to be looking for leadership. Where do you think it's going to find it?
Well, Lou, I think where the leadership is going to come is from cash flow, because October and April are the two big months of the year when CDs mature. And there's billions of dollars of CDs maturing this month that will not be able to go back into CDs and will be looking for haven. I think will come into the market. And I think that will push it. I do also agree with Frank that the earnings surprises are going to be more positive than negative of the third quarter.
Why are October and April the heavy months? Because of the taxes in April?
It's the taxes in April in the cycle, ever since the 6-month CD became a favorite after 1987.
How do you feel about interest rates these days?
I think interest rates are down. They're going to stay down. I don't think they'll go a lot lower, but they're not going to go higher, and I think we'll have a benign bond market for many months to come.
You still buying stocks?
Yes, sir.
Any you like particularly?
I like the total return stocks. I like the energy stocks like Mobil, Exxon, Amoco, and I like some electric utilities. Boston Edison is one. Dominion Resources in Virginia is another.
Total return, like the old line, you don't want the return on your capital, you should be concerned with the return of your capital?
Absolutely right.
Ed Brown, what do you make of what's going on?
Well, I think there are a couple of significant things that will have some lasting impact on the financial markets kind of undergirding, and that is the situation with the largest pension fund this week, TIAA-CREF, releasing their corporate governance policy, basically increasing shareholder activism will put fire under boards of directors, especially that's heavily concentrated with inside board members, and that's underperforming. And the second thing, I think, is the lifting of sanctions on South Africa, with South Africa re-entering the world community, I think will cause a lot of demand for stocks that have been off limits for a long time, but it will be slow.
What sort of stocks do you think will benefit from the lifting of the embargo?
Well, two groups that's traditionally been off limits that I don't particularly favor at the moment would be a lot of the major pharmaceutical companies, the energy companies, the international oils especially, and even a company like Microsoft, which I do favor, has been on the restricted list of many institutions.
Because they did business in South Africa?
That's correct. That's correct. Either you do business or sometimes licensees there.
What do you favor?
Well, I like some niche companies like Green Treet Financial. It's in the business of financing mobile homes, and they have a huge market share in that business. I like some of the higher yielding situations. Bill mentioned some. I like some of the REITs, like mobile home communities. The general growth properties would be another one. And even some of the moderately priced restaurant companies that come down quite a bit, the Cheesecake Factory and Cracker Barrel Old Country Store.
Say moderately priced restaurants, are you referring to the menu or the stock?
The menu. And the stock.
Well, no guarantees as usual, but in any event, it is time now to give our viewers the answers that they've been waiting for. Frank Cappiello, Robert Durrell of Frederick, Maryland, is dissatisfied with the increasing trend of replacing municipal bonds in traditional certificate and coupon forms with computerized so-called book entries. I have been reluctant to purchase any more of the book entry form bonds, he writes, because they are late in paying the coupon. Of the two I own, one was paid 15 days after the coupon date and the other 6. I grew up understanding that you paid your bills on time. The broker blames the paying agent. Shouldn't the broker be held accountable? What gives? And what can I do to remedy this?
Right on, Lou. Well, first of all, in book entry, the bond issuer pays the interest by wire, and he pays it to the paying agent on a due date. Not to do so would put the bond issue in default. Paying agent takes that money and on a due date pays the bank, the bond holder. Not to do so is a violation of law. It seems to me that neither of these parties are the problem. However, he should ask the paying agent why things are late. I suspect the real problem is the broker, and I think the third participant, the broker, is probably keeping the money for an extra day or two.
How can he find out about that?
Well, check with the paying agent. If the paying agent says, yes, we paid it into your account and it hasn't been debited, then you go to the brokerage house and you tell them the situation. If they don't cure it, you do one of three things. You fire the broker, or write the SEC, send a copy to the broker, write the State Securities Commission, send a copy to the broker. I guarantee you'll get action.
Take more than 15 days, I want it.
Yes, it will.
Bill Waters, Emmanuel Finkel of Brooklyn, New York, says he owns some utility stocks of what he calls the mama and papa variety. Usually, he writes, there is little activity and slight price changes, except for 4 times a year on the so-called ex-dividend days, when volume increases dramatically and prices show great swings. I have been told, he says, that this is caused by dividend play. Queries: what exactly is the significance of ex-dividend days? What is dividend play? Who's playing? And is it a private game, or can anyone get in?
Wow. Well, the ex-dividend date, single, is the first date on which the buyer of the stock does not get the dividend. And a dividend play is simply a tax thing, Lou, where a buyer on ex-dividend date wants to pay down, because on ex-dividend date, the price is reflected downward by the same amount as the payable dividend. The buyer gets a lower basis, and therefore a more chance at capital gain and doesn't have to pay taxes on the dividend. The seller, who may want dividend income, gets the dividend, gets a lower price on the buy side, and may have a lower capital gain. It depends on your tax status, and it's done in size, and it's mostly done by institutions.
Hard for us peons to make a buck out of that?
Well, we could play, but we would play small, and it wouldn't really...
Are you joining us peons now? I'm glad. nice to have you on the team.
Thank you. Nice to be here.
Ed Brown, one of the exciting things about American life is that kids do sometimes grow up. What would be your response to this letter? Dear Louis, exactly half my life ago, 16 and a half years, the wealthy father of a friend of mine advised me to invest in fiber optic technology. Being too poor, timid, and countercultural at the time, I ignored the advice. I hate to think of the opportunity lost. Is there still a chance to cash in on the bonanza? Capitalistically yours, Dan Urbach, Lake Oswego, Oregon.
No, it's not too late. Of course, in the first part of the decade, he didn't miss too much. The last 2 or 3 years, it's been a bonanza. The stocks are not undiscovered, so they are very richly priced. I think the most exciting opportunities exist in companies that provide the electronics for the transmission of fiber optics. 2 or 3 would be DSC Communications, ADC Telecommunications, and Tel Labs. Currently, they get about 25 to 30% of their revenues from this area, but over the next 3 to 4 years, it should be up to 40 to 50% on the first 2 companies.
All righty, now if you think you have the fiber to be a successful investor, don't wait for the next generation of technology before you communicate with us. To paraphrase the movie The Graduate, remember this word: right. And the address, just in case they failed to mention it at the protest rally, is Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take one of our periodic looks at why every self-respecting market technician treats the sentiments of his colleagues with contempt, as we track the embarrassing record of market advisors. So come along as we are going to take a sentimental journey. Our trip begins with the Dow at 689 on August 2nd, 1963, the first year Investors Intelligence conducted its poll of market newsletter writers, with 91.4% of those surveyed bearishly calling for a short or long-term decline and outright bulls at an all-time low of less than 9%, the Dow then proceeded to rise 250 points in 21 months. 10 years later, in a week when the Dow was moving to new highs, nearly 62% of those polled thought the market would head even higher. And what came to pass? You guessed it, down 470 points in 23 months. Not surprisingly, by the time the Dow slipped to a 12-year low at 577 on December 13, 1974, the mood was glum again. More than 63% of market advisors surveyed called for further declines. And true to form, the market rose 425 points, or more than 70%, in just 14 months. On January 14, 1977, with only 21% of the advisors bearish, the crowd missed the mark once more, as the Dow derailed with a 235-point loss over 14 months. And just over 11 years ago, with the Dow languishing down at 784, the clouds again hung heavy over Wall Street in anticipation of further declines, with nearly two-thirds of the advisors feeling bearish. The market, in turn, took off with a vengeance, rising more than 1,900 points in 5 years. On August 28, 1987, the week the Dow touched its then all-time high at 2722, more than 60% of the advisors, not to put too fine a point on it, were full of bull. 7 weeks later, the Dow, you may recall, was more than 900 points lower. On December 2nd, 1988, though, with the Dow just under 2,100, only 21% of those polled were bullish, the lowest total of optimists since June 1982. And so, of course, in the 58 months since that orgy of negativism, the Dow has gone up more than 1,500 points. And today, well, the outright optimists are still distinctly in the minority. Their numbers well below the bullish extremes that have triggered major sell-offs in the past. Well, you can't win them all, but can't these guys win any of them? And why do the majority of those trying so confidently to sell you investment advice consistently turn out to be wrong? For some thoughts on that and other ticklish questions, let's go over now and meet tonight's special guest, Thomas Monahan. Tom, welcome. We're very pleased to have you here tonight.
Nice to see you. Thank you.
Tom Monahan used to sell other people's research ideas, and he did so effectively that he became one of the most successful institutional brokers in Wall Street for the past 14 years for First Boston. But he was never just a peddler. Indeed, his ability to match First Boston's research with the customer's needs was so noteworthy that in May of this year, he was moved into the firm's top research job, directing more than 50 analysts who follow more than 750 companies. Tom, what do you make of all the continuing doubt and caution among these professional market advisors?
Lou, I think that a lot of the caution is a reflection of people looking at traditional measures of investment in terms of price to book, price earnings, yield on the stock market, and they figured it probably never gets better than this, and that fear kept them out of the market. I think it comes at a particular time with many of the growth investors who were lagging. They had a great decade in the 80s. I think that they never realized how much what the impact would be from lower rates and the liquidity that we would put into the system.
What's your advice to investors today?
My advice to investors today would to be a buyer on any pullback here that we have in the market, on any corrections. I think any correction.
How much of a correction?
I think you might have a 3 to 5% correction at the most. I don't think it would be any greater than that, and I think the leadership will not change with any correction that we have.
Your forecast for the next 12 months is on the high side compared to the consensus, is it not? What are you predicting?
Oh, I think you can see a market that will be led by small-cap stocks, mid-cap stocks, a lot of investing in the international markets from here, Lou. I would not be surprised to see the stock market up another 10 to 15% going out over a 12-month period.
Would you wait and not buy any stocks now, waiting for that pullback?
No, I wouldn't.
I
would be a buyer of stocks. If I were a conservative account, I'd buy something like AT&T. I think in the restructuring, they've taken some pretty interesting moves in here. I think going out as you get towards 2000, you're likely to see AT&T be 35 to 40% international. I think from here in the long distance, I'd be a buyer of MCI in here. In that whole area of communications, telephone, as you know, is buying McCall Cellular. I think that's going to be a great acquisition for them, and I think if I look forward over the next 12 to 15 months, they'll take the second part of that by buying Lynn Broadcasting somewhere probably around 145, 148.
The telephone situation is interesting because it represents a phenomenon common to the market today. They're taking over McCall Cellular, so the market immediately sold them off. Any company taking over another company, they tend to sell the first company. Is that sometimes a mistake?
I think it is. I think that I think there was some arbitrage pressure on telephone to do it. I would be inclined to be a buyer of McCaw as a cheap way of getting into telephone from here, but actually I would buy both stocks at this level.
The panel is calling. They want to talk to you as well. Let's let in Frank Cappiello.
Thank you, Lou. Tom, over the past couple of weeks, the Dow Jones Utility Index seems to be losing a little momentum. The trend is still up, but it seems to be softening. And all of us know that this utility index is a good forecaster of interest rates 6 months out. What's your feeling on utilities at this point, electric utilities particularly?
On the electric utilities in here, I would continue to own them if I did have them. I don't think we have any fear in here of a GDP growing much more than 2.5% or 3%. I don't think you're going to have inflation higher than 3%. I think the pause that you've had in the electric utilities here is similar to the pause that you've had in the bond market, but I don't think we're going to see any major backup in here. We do believe that long bonds will trade somewhere between 5.5 and 6.25 over the next year. Under that scenario, I would continue to own the electric utilities. I think electric utilities are cheaper than bonds.
Tom, the financial stocks, banks, brokers, insurers have had a big ride in 1993. Do you think the party's over, or do you see more room for growth on the upside?
I think there's a lot more room in the financial stocks from here. I think every portfolio should have a lot of exposure in there. We continue to recommend the bank stocks. I would continue to be a buyer in here of First of Chicago. I'd be a buyer of Chemical Bank in here, Chase Manhattan in here, maybe something like Fleet Financial for a regional bank. I think the insurance stocks have a long way to go selectively. I would buy a stock like Unum in the disability insurance area, and I think that's a very attractive stock in here. Horace Mann, which is a specialty situation that sells into the teachers market. I'm concerned about pricing, in the property and casualty area, but I think financials, brokers, and money management firms are still very attractive.
Tom, there's a lot of downsizing, right-sizing going on in corporate America. Do you see any interesting restructuring plays in the marketplace today?
I think that we will continue to see an ongoing announcements going forward on restructurings. I think what you've seen so far is just the beginning. I think Tenneco in here could probably be very attractive in here, not only from a restructuring point of view, but I think the J.I. Case division there is going to get the right part of the farm equipment cycle. I think, as you know, Kodak is also going through a major restructuring. I think these are stocks that make a lot of sense, and I anticipate that we'll see something along the line of Delta in the not-too-distant future and their European root structure.
Other than subdued inflation, why are you so high on the financial stocks?
I think the leverage in the financial stocks that you get, Lou, from the lower rate environment that we have in here, I think also, particularly in the case of the banks, what you've seen here is a period here with some of the banks, their loan loss provisions, they are now over-reserved, and that's probably a discussion we wouldn't have had in the past. I think the multiples are
too cautious?
Well, they took a lot of pain. They had to take a lot of write-offs in here, and I think the Fed would like to, in some cases, recapture some of those reserves there so they can start paying some taxes. But I think this is a great environment for financial stocks.
I know you have taken a close interest in Mexico over the years. Do you think that NAFTA will be passed?
I think it's a 50-50 shot that NAFTA would be passed. In the long run, I hope it does get passed. I believe it will get passed. I think it's important to get it passed. And I think when you have a nation that's always going to be right next to us with 70 million people, the healthier they are, the more we can export to them, the better off we're going to be.
Will it be damaging to Mexican stocks if NAFTA is not passed?
I think initially the probability is that if it's not passed, you could see a 10% decline in the Mexican market. If it is to be passed, I believe, Lou, we're looking at a 20 to 25% increase in the Mexican market. I would be a buyer of the Mexican market. I think it's the cheapest in the whole Latin American area today.
Muchas gracias, Tom Monahan. Thanks to the panel. Hope you'll be back with us again next week when we'll take a look at one of the biggest problems facing the American economy, what's going to happen to the defense industry now that peace has broken out between the great powers. My guest will be Phil Friedman, a crack analyst of aerospace and defense companies, and he'll be giving us his appraisal of the likely winners and losers now under President Clinton. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser is a production of Maryland Public Television, made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you, by the Travelers, providing American business with insurance, investment services, and managed health care. The Travelers, America's umbrella. By MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. We believe the most important thing we earn is your trust. Prudential Securities. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS. WETA's local broadcast of Wall Street Week is made possible in part by a grant from the Johnston Lemon Group, parent sponsor of the Growth Fund of Washington, and by the Eugene B. Casey Foundation,